Welcome to my video on insurance financial terminology. When you're defining terms, don't just watch this video and write a one-sentence definition. I want you to actually go a little bit more in depth. This is to kind of outline all the issues that you should be thinking about when you define a financial term. I also want you to self-reflect and think about how these terms affect you in your life. So let's first talk about insurance and what we insure. And that gets us to the issue of risk. Risk is a bad thing that can happen to you, and when you're thinking about all the bad things that can happen to you, a couple of factors that are important for insurance. Will the bad thing cost you money, and what's the likelihood of the bad thing occurring? In order to have insurable risk, you've got to have a low probability of something occurring, and at the same time it has to be disastrous to you financially. Insurance is actually a bet that will help you mitigate risk. And I've got this in red. This is a financial term that you need to do a little research on. But the insurance bet, you're betting that something terrible will occur. You're putting a small amount of money up front, and the insurance company is betting that small thing will not occur, and if it does, they will pay off. So insurance helps you mitigate horrible risk. And let's look at some examples of risk. The first one is that a house burns to the ground due to an electrical fire. The probability of that occurring is very low. The financial cost to the person that it happens to is extremely high. It's disastrous. So that person wouldn't be a good idea for them not to mitigate that risk. This is an example of insurable risk. Now, who makes the determination of the probability of something occurring and the financial cost? Well, that's done by an actuary. That's a profession that is able to look at data that happens all over the world, all over the country, break it down by gender, by region, and make these determinations of probability of occurrence and the financial cost. Let's look at another example of risk. A house burning to the ground due to a forest fire. If you live in an area that's prone to fire, like Southern California in a forest, you know what? That is not a low probability. That's a high probability. And even though the financial cost to the person that it happens to is extremely high, it is not an example of insurable risk. If it's likely to happen, no one is going to take the bet that it's not going to happen. So an insurance company would not insure that. Let's look at the risk of a child dying. This is a horrible thing that can happen. Chances of it happening are extremely low, but the financial cost is not high. It's extremely low. Even though that emotionally it's a horrible thing that can happen, it isn't an insurable risk. There's no financial cost that's being insured. Next, you contract a chronic disease like hepatitis C. Chances of that happening are very low. Financial costs are extremely high and disastrous. Is this insurable? Yes. Let's look at wrecking your car. The probability of that occurring, it really depends. Some people drive their entire lives and never have a wreck. Some people wreck a car once a month. The actuary is going to make a determination on who is a good risk or who has a low probability of risk and who doesn't. And they're not going to insure people who they don't think have that are good drivers, or the people that, if they think that someone has a high probability of a wreck, they're not going to insure them. So you 16-year-old boys, you young men who are watching this, your probability of occurrence has been determined to be extremely high by an actuary, so they don't want to sell you insurance. So the for-profit insurance model is really driven by the actuary. They have to determine which individuals have an insurable risk, and then the insurance company is going to hire agents to sell insurance policies and collect insurance premiums. These are both financial terms. Insurance policy is the contract that defines the bet between the insurance company and the individual. It says what is covered and what isn't covered. The premiums are the monies that are paid by the individuals. It's their bet they're making with the insurance company. So these premiums are collected by the insurance company, and the insurance company then invests the money because it doesn't need the money immediately, because the the claims will happen in the future. So they need to invest the money and earn money in order to have money to pay off the claims when they occur. Now, insurance companies are actually financial intermediaries. Okay, insurance claims, when they're made by an individual, are evaluated by the insurance company to make sure they're within the terms of the insurance policy. If they're not paid. So you think of a really easy one, like life insurance, that is payable upon the death of the insured. Well, if that person is dead, they have their family shows a death certificate, then the insurance policy should pay. But if the insurance policy has an exclusion on something like suicide, then the insurance company may want to investigate and see if the death was caused by suicide, in which case they could deny the claim. So this makes the insurance company in a private market extremely powerful. If they collect $100 in premiums and they don't pay any claims, they earn that $100 plus any investment income. Everyone knows that is a possibility with insurance companies. So insurance is tightly regulated by every single state, and they make sure that insurance companies can't just collect premiums and not pay out any claims. So they define what things need to go into insurance policies and what kind of claims need to be paid. A lot of that is regulated by the states. It's different state to state. Not all types of risk are insurable. For example, flood insurance. That isn't insured by the private market. In the United States, that's insured by the federal government. Here's the website for FEMA, the National Flood Insurance Program. Who's at risk for a flood? People who live in a floodplain. So no private insurance company is willing to take those bets, because people who have a high risk of flood are the ones who need insurance the most, and that isn't going to work in a private insurance model. So the federal government handles that. For health, a lot of countries don't have a private insurance market. In the United Kingdom, the government pays all medical bills for everybody. Here is a link to the National Health Service in the UK. It's not insurance, it's a service. So everyone gets their bills paid in the UK for all of their medical bills. If a person is sick, they don't need insurance. They need somebody to pay their bills. So that's how it works in a lot of other countries. Auto insurance. This is a link to the New Mexico website, Mexico State Motor Vehicle Department website, and it defines what the insurance requirements are in the state. The state doesn't want you on the road if you're not financially responsible, because you can do a lot of damage. You can run into someone else's car and damage their car. So if you cannot get insurance because you're a high risk in the state of New Mexico, you actually need to put a deposit of $60,000 down with the state. So if you do harm somebody, there's money there to take care of any damage that you cause. So study hard, good luck. Make sure that you use authoritative sources. Make sure that when you define terms, you're using financial terminology, not just colloquialisms like you're texting your friend.